Good morning from London. I'm Kriti Gupta alongside Valerie Tytel and Oliver Crook. We're an hour away from the opening trade. Here's what you need to know. Tariffs go into effect worldwide as President Trump adds even more, declaring plans this time for a 100% tariff on chips, but exempting firms that invest in the United States. President Trump also saying there's a, quote, very good chance he would meet both President Putin and Zelenskiy in yet another bid to broker peace between the two countries. And earnings season continues in Europe. We'll break down the numbers and bring you conversations with the CEOs of Sandoz, Merck, and Maersk this hour. Val.
Equities are looking positive hour ahead of the opening trade. S&P futures trade higher. We're also seeing Euro Stoxx futures outperform this morning, up 0.6%. That's kind of been the theme of the week, Kriti. We're seeing this European stocks just outperform just slightly on the bounce back from Friday's weak payroll number. Euro dollar a lot stronger. Yesterday's session was very much about dollar weakness in the face of all this dovish Fed speak. U.S. 10-year yields continue to creep higher. We're just shy of 4.25 on the U.S. 10-year yield. The countdown to the opening trade starts right now.
We'll be putting a tariff on of approximately 100% on chips and semiconductors. But if you're building in the United States of America, there's no charge.
If you invest in the States, there's no charge. But if you don't, looking at 100% on chips. And of course, this is something Donald Trump has touted for quite some time. We just didn't know the number would be that high. Is this something that the markets are used to, or is this just piling on to some of the other massive numbers we're getting? Remember, reciprocal tariffs go into effect around the world today, including the 39% on Switzerland as well. Guys, I don't know where to start here. I feel like chips is the obvious answer, because we've been waiting for this for a while, and we've been waiting for it to hit some of these mega cap tech companies, specifically in the States. Apple, a great example of an exemption and how to navigate it.
Yeah, there's a lot to unpack here, right? So there's the fact that we actually have a little bit more clarity on the kind of very vague tariff regime that we've had in the United States. You talk to a lot of CEOs that we have been talking to over the last few days. Maybe not quite as much clarity as they would like. But again, we look at the exemptions, the way that Apple got out of this by committing another $100 billion to building in the United States. That adds to the CapEx commitment of $500 billion. That makes $600 billion. As Dan Curtis points out this morning, in the last 30 years, Apple has only spent $166 billion. Is that a real number?
Well, they got a lot to prove to the president, I guess. But the exemptions are the real win here for the chip industry. I mean, just take a look at TSMC, the world's biggest chip maker over in Taiwan, up some 5%. We're also seeing the likes of the South Korean chip makers, such as Samsung, SK Hynix, also trade positively. So this is a big win in terms of the exemptions that a lot of these chip makers are getting. Remember, so many of these companies have already pledged investment to the U.S. TSMC, as we know, is building that plant in Phoenix. Samsung, Texas Instruments, Micron, Global Foundries, the list goes on and on. So it's quite a big win when it comes to the exemption list. And to me, this is just another tariff threat we no longer have to worry about.
And they front-run this, right? Because we knew so long. We kind of assumed that there would be this pillar of a U.S. investment there. Then you just named a great list. And it's why I think in the markets picture, you're not actually seeing that kind of pain, at least reflected in the futures, that maybe we would have, say, 3 months ago. That's on top of potential pharmaceutical tariffs that are also coming in the 100, 250% that he's floated.
I thought the price action on Intel aftermarket was really telling. So Intel is a homegrown U.S. business. They're also a foundry. They're a chip designer. The shares initially rallied near 5% after market, with the initial thought that maybe these tariffs will in some way protect U.S. homegrown companies. But now it seems like many people are getting the benefit. So it's not just Intel getting the benefit, but a lot of these foreign nations as well. That really chimes with what we've heard and the kind of conclusion to auto tariffs, that it's not necessarily helping the big three U.S. auto names as much as some of the tariff reprieve has helped foreign makers.
And I think that also pricing the sort of Trump trade, whether it's tariffs on chips, on whatever else you have, there's another thing that we have to talk about, which is the other sort of deadline that we have tomorrow, which is potential bone-crushing sanctions on Russia, and on those who buy crude oil from Russia. Now we're hearing from Trump that he actually might have a meeting with President Putin, President Zelenskiy, as early as next week. So I don't know exactly how we get from bone-crushing sanctions to a meeting without precedent in such a short period of time. But again, maybe it's part of the art of the deal. Maybe this is something that isn't really going to happen. There's probably some diminished expectation for this actually happening. But of course, as risks go for the oil market, this is something that is real if you were to get sanctions.
Yeah, it did have quite an impact on the oil market yesterday. You had WTI and Brent trade lower by more than 1% on the hopes of a ceasefire, that also denting the oil price. But you have to weigh that that up with the threat of secondary sanctions. We know that's lifted the oil price recently this week, so it's been a lot of two-way for crude.
Actually, a 6-7 handle on Brent as we speak, although the geopolitical risk has widened a little bit, and I think that is notable in this oil market. It's also worth mentioning they're now officially 50% of a tariff rate on India, again, to address this Russian oil story. And that is going to be another key piece of the machine that is potentially powering Russia at the moment.
And the other thing that it affects is not only the oil market, but potentially the defense industry. If you do see some softening with the situation between Russia and Ukraine, you just had numbers out of Rheinmetall. I don't even know where to start on all the records. I mean, their backlog is at 65 billion euros. That's versus 40 billion last quarter. The stock is up 1,600% since the beginning of the first war, 250% in the last year. And, you know, the CEO saying that basically customers are buying entire factories from them today. So that is something that's also going to be paid attention to in the earnings story if we do see any progress between Russia, Ukraine, United States.
Yeah, and also on the earnings front, we do have results out from Maersk. This is the Danish shipping giant, one of the largest container shipping companies in the world. And we're looking at this for maybe some read on how Trump tariffs are impacting global shipping numbers. I have to say it's quite a bullish view from Maersk. They are raising their full-year underlying EBITDA guidance to the higher end of the range, now guiding 8 to 9.5 billion. Previously, they saw 6 to 9 billion. They also raised their full-year global container trade guidance to the higher end of the range. They're now guiding for a 2% to 4% increase. That compares the last time around they guided to a -1% to 4% increase. So narrowing that band to the top end of the range, both when it comes to EBITDA and global container trade. So this is some bullish news from one of the biggest container shipping companies based out of the Netherlands.
And we'll speak to, of course, the CEO there as well, specifically on this idea of where consumer sentiment lies, whether the tariff impact is showing up. There's another place where you might actually see some of that impact, at least on consumer sentiment, and that is in IHG earnings. Now, we are getting the numbers here. The pre-tax profit, a massive beat for the entire first half. We're looking at 633 million. The estimate was just about 517 million. So that is a pretty decent bid. We are also seeing that they're upping their dividend. It's still below the Bloomberg projection, but it is in the positive direction. So perhaps that is going to be something that's well received when it comes to the market open. We, of course, also have an interview with that CEO as well. But at the end of the day, we are still waiting for kind of those cracks to emerge in the earnings story, whether it comes from business investment outside of the United States, because we now know there's a big push to go there as well, but also consumer sentiment. And this idea that so many companies around the world are talking about CapEx spend relative to the fact that they are still waiting for that demand to hit, I think is really indicative of how much cash right now is in corporate America and corporate Europe.
And I think what's so interesting about talking to the CEOs we're going to be speaking to a little bit later today is to get some of these appraisals of what is going on under the hood, under these earnings figures. Where is the consumer, as you say, IHG? I mean, I remember when I spoke to the CEO of Accor, the big French hotel company, back in the spring, they said that the bookings to the United States from Europe after Trump's election was down 25%. What does that look like going forward as well? To say nothing of Maersk, which I think is, as you say, Val, very interesting to see not only a beat, you know, a lot of people are going to try to get things in under the line, that deadline at midnight tonight, but actually improving the outlook going forward in a more hostile trade environment, I think is quite interesting.
Yeah, and Maersk says that they raised that outlook due to resilient market demand outside of the U.S. That kind of is hinting that it's not just all this front running of tariffs that's keeping global shipping going at a higher than expected pace. It's also global trade outside of the U.S. that's helping it as well.
And does it undermine the Trump narrative that actually the United States is the only game in town when it comes to trade? A lot is being banked on that presupposition.
Absolutely. Lots of really interesting conversations and questions to be had. Let's tell you what we've got coming up on the show. Like we promised, we're chatting to the CEOs of Sandoz, Germany's Merck, and Maersk as well. We're going to have those exact conversations with these executives that we just had around the table. But then, of course, a quick check on the consumer confidence as well. There's trade, there's geopolitics, but how's everyone feeling right now? We've got a perfect guest, IHG Chief Executive and CFO of Allianz, going to walk us through where people are ultimately spending their money, and that's going to be a crucial piece of this narrative.
And again, 10 minutes into the show, we have not mentioned the Bank of England, which is the other thing we're watching very closely later today at 12 o'clock from the BOE. We get that rate decision. We will be followed by a press conference, an interview with Andrew Bailey. And before the bell, Eli Lilly, again, closely watched in the pharmaceutical sector. U.S. unemployment claims, of course, also closely watched in that 30-year bond auction we mentioned yesterday. And to talk about the story we have sort of neglected this morning, we can get out to Lizzie Burden, who's outside of the Bank of England, to give us sort of the appraisal of what to expect from Threadneedle Street.
Hey, Ollie. Well, the expectation among economists and markets is that the Bank of England today is going to keep going with this quarterly cadence of quarter-point cuts, so taking the key rate to 4%, which, of course, is now lower than the Federal Reserve. And it's against a backdrop of inflation at a 17-month high. But the reason for it is that you've got back-to-back contractions in the economy and a slowdown in hiring, and that comes back to domestic issues, that rise in the payroll tax and the rise in the minimum wage as well. And so, yes, we're expecting to see an increase in the short-term view of inflation, but it looks like they're going to cut anyway. So when you look at the vote split, because of this stagflationary backdrop, economists seeing a three-way vote split, same as we got 3 months ago when they cut last, and that's going to be 2 expected to vote for a half-point cut because they're worried about the stag, 2 expected to vote for a hold because they're worried about the inflation, and the rest for this quarter-point cut. And so a hold, a half-point and a quarter-point, as that would be the split. Now, the big surprise that we might get today is that they remove the word gradual from the guidance. It's not what most economists are expecting, but if they do, our team thinks that that would be a hawkish hint, because at the moment markets are expecting just one more cut by the end of the year after today, but that maybe would mean that they're going to take November off the table.
All right, thanks to our correspondent on the ground, Lizzie Burden. We'll look forward to your coverage later today. Remember, it's not just the Bank of England decision, but they also released their updated forecast and a press conference. So it's a big one for the Bank of England. Here's what else you need to know this morning. China's export growth unexpectedly accelerated last month, and the fastest gain since April. The resilience in overseas shipments came in despite high tariffs imposed by the U.S., suggesting that global demand remains a significant driver for China's economy. And the Swiss Federal Council says it will hold a, quote, extraordinary meeting later today to discuss U.S. tariffs on Swiss goods. The announcement comes after Switzerland's president left Washington without announcing any success in swaying President Trump to lower the 39% tariff on her country. And lastly, Novartis is reportedly weighing a takeover of a rare disease-focused biotech firm, Avidity Biosciences, in a bid to boost its drug pipeline. According to the FT, the talks are still at an early stage with no guarantee of a deal will be reached. Novartis is seen as a need to portfolio boost as 3 of its key drug offerings face generic competition this year.
M&A back on the table, it seems, when it comes to states. Coming up on the program, Allianz posting a beat and backing its outlook. We'll check on the share moves and talk to the CFO later in the show. Plus, in the defense space, Rheinmetall missing their first half estimates, but expecting to benefit from the ramp up of European defense spending. More on those results and the potential cracks to come. But up next, right back to the pharmaceuticals, an exclusive earnings interview with Richard Saynor, the CEO of Sandoz, after his company's strong earnings print. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg. Just under 45 minutes away from the opening trade. When you look at the futures picture, I'm going to go ahead and call it mixed. Some marginal positivity when it comes to Euro Stoxx 50 futures, higher by 0.3%, but a notable underperformer, although only by a little bit, is the FTSE 100, down about 0.2%. So I want to say it's about 0.5% divergence between the two benchmarks. We'll see if that shakes out as we get closer to the opening trade across Europe. In the meantime, we are, of course, digesting a good chunk of the earnings picture and perhaps some of the geopolitics and the tariff headlines that come with it. Top of the bucket this morning is, of course, Sandoz, one of the major pharmaceutical players based in Switzerland. They're coming out with net sales that beat their average estimates, but perhaps exclude some of that tariff impact. We're going to dive into the details now. We're pleased to say we're joined now by Sandoz CEO Richard Saynor on the program. Richard, a pleasure to have you. Thank you so much for your time this morning. Seeing some strong numbers across the board here, a slight miss when it comes to those North American sales. But I think what really stood out to me in some of these numbers, that despite the strength, we haven't actually modeled out, at least in this earnings numbers or this earnings set, the impact of potential tariffs coming down the pike. Can you give us some insight on how you're thinking about it?
Yeah. No, thank you. I mean, we already modeled in a modest impact. Obviously, we had some visibility of the tariff impacts at the beginning part of the year. I think when we discussed it at the first earnings call at Q1. Our guidance includes now what we know. So we've assumed the tariffs relative to Europe at about 15% and so forth. So our guidance includes that. We estimate that's going to have an impact of about $25 million for the full year. If that then continues into next year, roughly 60 to 70 million. But again, that we've assumed that building into our guidance. It doesn't change the numbers in terms of how we see things going forward.
Richard, that's at least on the pharmaceutical tariff perspective, and we're, of course, waiting for those numbers to change. I hear you on the fact that we don't have clarity there yet on that particular rate, but we do have clarity on other parts of the world, at least when it comes to the EU and notably India this morning, where we know that you, Richard, and Sandoz has quite the supply chain and the business extension there. Can you just walk us through the impact in terms of the international tariffs that may be hitting your business?
We see very little in terms of that. I mean, as I say, we're a very strong European player. More than half our revenues come from Europe. A lot of our manufacturing is based in Europe. We also have manufacturing in sites around the world. So again, we don't see any significant impacts there. And again, it's worth stressing that, you know, as a generics industry, we're generally at a low cost. We've provided an essential part of the healthcare system to many markets, including the US. So I think we're having the right conversations about how we drive access and affordability for these medicines. We're not like some of our big pharma competitors with very high pricing, very high margins. This is a very different kind of business. It's very global. Sandoz is the world's leading generics and biosimilar player. And again, I think we're well positioned to build on that going forward.
Hi, Richard. It's Valerie. I have one question more on tariffs, because maybe unlike your other big pharma peers who are based in Switzerland, you've got no production in Switzerland. Do you see this as offering a perhaps competitive advantage for your business over peers, because the higher Swiss rate you're really not at risk of?
Well, I think our peers generally are other players. There aren't any other greedy global generic companies operating out of Switzerland. So I think from that point of view, I think it's not so important. I do think it's interesting when you look at where a lot of the other competitors come from, particularly from Asia, depending on the tariffs there. But again, let's get back to why this is happening. This is really a frustration in the US healthcare system about access, availability, and affordability, and really thinking about how we support that. And I think actually I'm quite aligned with what the administration's trying to do, in the sense that he wants to make sure that patients get access to affordable healthcare. Generics and biosimilars in the US supply roughly 90% of all of the drugs used for about 13% of the cost. 4 of the originator brands in the US cost more than all of the generics and industry biosimilars put together in the US. So we have a critical role to play, and we need to think about how we get more structural reform within the US market to make sure that we can bring products to patients.
You know, Richard, we know that Trump has talked about wanting that kind of structural reform, wanting to pressure drug companies to lower prices. Is that another avenue of a competitive advantage for a business like yours, who offers generics at lower prices, in some way shielded from this kind of pressure from your global peers?
Absolutely. First of all, I would say, I mean, we have really strong access to the current administration. I think we've been able to have conversations that we've not been able to have with previous administrations, whether it's in the House or in the White House. So certainly, I think they understand the fundamental issues, whether it's patent abuse, structural reform about payer frameworks, and also in terms of support in manufacturing. I'll give you a good example. Sandoz is the only remaining penicillin manufacturer left in the Western world. So, you know, you have stark conversations with governments both in the US and in Europe. Where do you want to access these critical medicines from? Do you want to access those from Asia, or do you want to access those from at least a European supplier? So I think that gives us a very strong position to talk to governments. They recognize the critical nature of our industry, the value that we bring to society, the huge impact in terms of healthcare budgets, and the importance of what we're trying to do.
And Richard, you talk about strong access to the Trump administration. I'd like to take advantage of that for a moment, if we might, because you might have a clear understanding of some of their policies going forward in terms of the pharmaceutical industry. As you say, structurally want to bring down the costs. What is the other pieces of advice when you speak to the Trump administration in trying to achieve that policy goal, apart from tariffs, that you think would make a great difference for the United States?
No, it's a great question. I think there's, again, 2 parts. I think what we've been able to establish is really there are 2 industries here. There's the originator industry, high pricing, and I think that's a very different segment. Clearly, as I explained, the generics and biosimilar sector is very different. It's a much lower price, have very high volumes. It's the majority of healthcare in the US. And there, I think the challenges are things like patent abuse. Clearly, originators continually evergreen patents use their position to prolong patents, I believe, unfairly. That inhibits competition. And then when you look at the market, some of the structural elements of the market make it very difficult to open up the market. Let me give you a good example. So we launched adalimumab, our own Hyrimoz, against Humira nearly 2 years ago, and yet nearly only 25% of the market today is converted to biosimilars. Now, when you compare that to, say, Europe, you see about a 70 to 80% penetration rate. So there are some structural issues in the US that need to encourage more competition. Ultimately, it's competition that serves patients, brings down prices, and opens up markets. And I think those are the conversations that we're having with the administration.
And I think many of the conversations that people are having around the administration is that many people are potentially on board with a number of the aims of the administration, but have some questions about the methods. As someone who runs a large pharmaceutical company, when the Trump administration is talking about reduced tariffs at first for pharmaceuticals, then 150%, then 250%, does that encourage change for a CEO like you to build manufacturing in the United States? Will that work? Will you do it?
Again, what I said before, and several times before in terms of being asked that question, what I do need to see is more structural reform in terms of the attractiveness of the market. And the challenge of that market existed a year ago, 2 years ago. So tariffs, in a sense, only accentuate the structural challenges that we face in the US, whether it's challenging the patents, as I said, opening up the market, changing the payer frameworks, and getting better visibility and access. Those are the things that would encourage us to invest and think about how we want to build capacity in the US. But those problems existed before this administration came into place.
So, Richard, those are your thoughts on the Trump administration. Let's talk about perhaps a question that a lot of your shareholders and investors are thinking of, which is in this environment where you are facing that kind of pressure and the industry is facing that pressure to bring down prices, how does Sandoz increase their margins in that environment? We know that that Sandoz specifically has a lot of fixed multi-year contracts. So in terms of increasing margins, increasing sales, et cetera, how do you then navigate that environment given the structure that you operate in?
Well, first, let's think about going forward. I mean, as Sandoz stands today, we're the world's largest supplier of biosimilars and generics globally. The US market actually is less than 20% of our revenues. Actually, the biggest market we operate in is in Europe. And when you look forward, there are more products coming off patent, particularly in the biosimilar space, than there have in the history of this industry. So already we have more biologics launched than anybody else in this industry. We have a stronger, broader and deeper pipeline. And then we see this incredible number of opportunities going forward. Now, biologics generally have a higher margin. They're more complex to develop. They're more expensive, but also they're much more sustainable over a longer period of time. So let me give you a good example. We were the first ever company to launch a biosimilar human growth hormone, Omnitrope, nearly 20 years ago. Today, we now supply nearly 35% of the world of human growth hormone market. Very strong, highly margin accretive, and continuing to grow. And we're expanding that biologic portfolio. And also, you've got to remember, we recently, only 2 years ago, stepped out of a very large pharma parent. Now, we operate in a very different kind of market. We're used to high levels of competition, highly price sensitive. And that gives us a lot of structural elements to think about how we become a pure generics business rather than coming out of a larger pharma company. So I think there's some both structural elements, and you start seeing that coming through in the P&L, but also significant growth elements. I think one of the standout things that I'm really proud of from
Richard,
H1
I'm so sorry to interrupt you. We are hitting a commercial break, but I really appreciate your time and walking us through those dynamics. Richard Saynor of Sandoz. Stick with us. This is Bloomberg. Minutes away from the start of the opening trade. We can take a look at the futures picture. It feels a little bit calm, maybe a little bit sleepy in these markets. Take a look at this. Higher by 0.4% on your Stock 50 futures. The FTSE 100 marginally in the negative territory, but I think perhaps recouping at least the check that we had or the losses we had about 30 minutes ago. I think it's the divergence that really matters between your Stock 50 futures and the FTSE 100 today.
Let's check on how fixed income is opening. Again, quite a sleepy mood when it comes to European government bonds. We're up by less than a basis point, but the theme of this week has been yields ticking steadily higher after the monster rally after the payroll miss on Friday.
Yeah, what is not sleepy is the earnings story this morning, and we're just continuing on that with Merck out of Germany dropping their numbers a little bit earlier this morning, cutting their sales outlook for this year. That down to a lot of currency headwinds that they are experiencing. There are, of course, big questions, not only on the currency market, but on tariffs. And we're very pleased to be joined now by Belen, Garijo, the CEO of Germany's Merck, to shed some light on some of these moves. Let's start there with the currency market, because it seems that that is really the protagonist in your earnings this morning.
Good morning, Oliver. Thank you very much. Look, you know, the currency is something that we don't control. So we really focus on our results on an organic basis at this time. And as you have seen, we have delivered a very robust quarter with 2% organic growth and almost 5% on earnings growth, an acceleration of our life science business, process solutions on double digit, and, you know, healthcare very, very solid. In that context, we have raised our earnings expectations to +4 and +8, or between +4 and +8, coming from 2 to 7. So we are very confident, and that's despite, you know, the earnings raise reflects truly our confidence on our ability to deliver despite currency headwinds, despite the acquisition of SpringWorks, and despite the divestment of Surface Solutions.
The one thing you didn't mention there, and I think that may give pause to some people who are seeing such a confident outlook, is the question of tariffs and the unpredictability that we're seeing from the United States and what we're still waiting to see on the pharmaceutical sector. What are you expecting there, and why are you so confident that it will not have a material impact on Merck?
Look, all the tariffs are included in our guidance. As far as what, you know, as far as we know, the environment will stay, let's say, volatile, but everything that we know to date is included in the guidance that we have published today. So, look, you know, we have been talking about unpredictability for the whole year, and we are not expecting this to change anytime soon. So what we have done is really integrate what we know and what we can control, and this is the guidance that we have put forward. So, again, confident.
Belen, you just mentioned there that all the announced tariffs are currently in your guidance and in your framework. But I want to ask on maybe tariffs moving forward and how you plan to adjust your business in order to mitigate the tariff impact. Are you in any way moving production to the U.S. or changing location of where some of your items are produced?
Look, we are heavily invested in the U.S., very heavily invested in the U.S. The U.S. is our largest market and source of revenue. In 2024, we delivered $5.7 billion out of the U.S. And we have 14,000 employees, 71 sites, and more than 35 manufacturing sites. So we will definitely continue to invest. We have, in the last few years, invested already $2.5 billion. We have made an acquisition of a U.S. company, and we will continue to invest in the U.S. because our intention is not only to keep our scale in a highly attractive market, but also increase our scale mostly on the healthcare business, which is still a bit subscale in that attractive market.
And Belen, more on the market in the U.S. Some of your competitors have recently announced direct-to-patient drug offerings in an effort to lower drug prices by cutting out the middlemen when it comes to the U.S. market. Is that something you're interested in? Is that something you are considering? And are you in touch with the U.S. administration about that?
Yes. The first thing that I would like to say is that making medicines more affordable is something very legitimate, but this should result from a very close collaboration between the industry and the administration. Of course, in the U.S., because of the structure of the market, a lot of money is lost between the pharma industry and the patient. At anything that can improve affordability of the patients, we are very positive towards.
Belen, it's Kriti in London. Talk to us a little bit more about making that affordable, though. So many of your peers would say that the trick to actually bringing down those prices is ultimately to go up in scale, which you've highlighted. How easy is that process? What does the timeline to do that actually look like?
Look, once again, we are very, very closely collaborating with not only with the administration, but also with all the U.S. trade associations. And I mean, we operate in chronic markets in which, we provide affordable access to many, many patients in those diseases that are, whenever is necessary. So once again, we are really positive to collaborate with the U.S. administration, and we are doing so, and definitely put patient first on anything we do.
Well, Belen, that is at least the pharmaceuticals side of your business. I want to talk about the other side of your business, which is the electronics unit specifically. There's a big question here about when you start to see a bigger turnaround, at least for that particular unit. Can you just walk us through whether you still expect that recovery to happen in the back half of this year?
Absolutely. Look, first of all, everybody knows that the integration of artificial intelligence is going to continue to drive the attractiveness of that market. And this is exactly what we are seeing. Our semiconductor materials market continues to perform very, very well above the market in that area, in that segment of advanced nodes, which is directly related to the integration of artificial intelligence. We have also seen a rebound of the market of mature nodes in China, which is contributing to our growth. So while the market remains volatile, we are extremely confident on the attractiveness of this market in relation to AI, which is being used more and more.
We look forward to seeing how this all pans out. Belen, Garijo, CEO of Germany's Merck, we thank you so much for your time this morning on your earnings. Coming up on the program, we're going to continue the conversation that we just had there with Belen around global trade, this time with bellwether Maersk, lifting their outlook for the year, even amid those tariff concerns. The CEO, Vincent Clerc, will be joining the program next. Stick with us. This is Bloomberg.
Welcome back to the opening trade. It is 20 minutes to go until the cash equities start here in Europe, and we are busy with earnings season. In the last few moments, we did get results from Merck saying they're raising their financial outlook for the year, saying demand outside of North America is resilient, even amid concerns over a trade war. Joining us now is Maersk CEO Vincent Clerc. Thank you for joining us this morning on the busy earnings season. We really appreciate your time. Can you walk us through your raise in guidance and talk to us about the demand outside of North America, the reasons perhaps that might be staying strong?
Yeah, I think what we've seen throughout the year here, since the beginning of 2024, actually, is almost a decoupling between demand for container services and GDP growth, as we saw a boom in manufacturing from China, and China gaining increasingly market share across the whole global trading system. We see this in all markets, whether it is Africa, Latin America, India, Middle East, or Europe. The only exception in the quarter was the US, where the situation is well known with the implementation of tariffs at the beginning, then the truce and so on. There we have seen a more subdued environment, as the uncertainty triggered more of a wait-and-see position from a lot of our customers. But for the rest of the world, I think the continued increase in the momentum that the Chinese manufacturing boom is having is fueling very, very strong demand. And that has led to a very favorable pricing environment for us. We have had spot rates that ended the quarter 37% above what they were at the beginning of the second quarter. And that means also we're headed into our traditional third quarter peak season with much more favorable and supportive pricing environment than what we expected, and hence enabled us to lift our guidance for this year and look at the rest of the year with a lot of more confidence.
Vincent, I want to focus on the volumes around in North America. You said that a lot of your clients are on wait-and-see mode, waiting for uncertainty to dissipate. You know, one could argue we've gotten a lot more clarity on tariffs in the last couple of weeks. Is it something you're more optimistic that we might see a pickup into the end of the year, those volumes into North America, into the U.S.?
I think it's definitely good that we're starting to see situation stabilize. The deal with the EU and some of the other deals were quite positive. What is really important for us right now is to see where this is landing with China, because more than 60% of US trade deficit is actually with China, and the bigger driver of volumes in our business when it comes to the US is going to be what happens with China. So this is something that has yet to get fleshed out, and once we have this in place, then I think we will see uncertainty ebb, and we will start to see customers actually understanding what they need to do now to adjust their supply chain to what is a structurally different trading environment given the tariff levels and the different deals that have been put in place.
Vincent, it's Kriti in London. I want to stick with that China theme, perhaps from a different angle. We know that we are all waiting for that tariff and trade kind of truce, if we can call it that. There's also concerns, though, around the United States and fees implemented on Chinese-built chips. Vincent, if you could just go a little bit more micro for me and walk us through just how much exposure you have to Chinese-built chips. What does your fleet look like? Are you looking to diversify to avoid that kind of impact?
So our fleet is fairly diversified. We have about 20% of our ships that have been built in China. The rest has been built in other places, mainly Korea and Japan or Taiwan. And the US represents about 15% of our business. So about 15% of our fleet calls the US. So I think for us, the implementation of these tariffs simply means that we need to adjust our deployment so that only ships from the 80% that have not been built in China actually service the US, and that the 20% of ships that have been built in China serve other markets, so that we do not have to subject our customers to recovery on these fees.
When it comes to, though, just the confidence in this environment that you're seeing, Vincent, you speak to plenty of CEOs, plenty of clients around the world. Although there does seem to be an element of consumer resilience, it does feel like business investment has halted. CapEx spend has halted unless you're a mega cap tech company because of that volatility. Are you seeing that lack of business investment show up either in your numbers or in your conversations?
Yes, we do, but I think what is important for me to underline is it seems that this is more a postponing of investments rather than a canceling of investments. So it is not necessarily that companies are getting more thrifty because they don't trust consumer demand at this stage, at least. What has been crippling for a lot of investments is actually the uncertainty about what is the new regime we're headed into. It is fairly accepted across all companies and all verticals that we are headed into a new phase of globalization, and that the new tariff regime is a structural change that will necessitate adjustments to the supply chain. And a lot of the conversations we're having with them is how we're going to execute that. But the uncertainty around the tariff regime with China, the tariff regime with India, which are two of the really big manufacturing bases today, the uncertainty also about how long these deals are going to last, and what is going to happen with some of the other countries, such as Mexico, which is also, let's not forget, one of the most important trading partner for the US. This is all driving at this stage more of a wait-and-see approach, so that these decisions can be made once there is a bit more certainty on what the new playing field looks like.
And I want to talk a little bit about the third quarter that we are currently in. As you know, the tariff deadline went into effect just a few hours ago. As the CEO of Maersk, the biggest shipper in the world, I'd love to get a picture from you of what the last couple of weeks have looked like in terms of trying to get shipments in under this deadline. How is that going to show up in the numbers? And you're concerned about that sort of ebbing away after the deadline, that people sort of front-loaded a lot of these to get them in under the wire?
So we've not really seen any front-loading ahead of some of these new tariffs that have happened. Our demand into the U.S. has been subdued already towards the end of the second quarter, and continued to be subdued for the last few weeks. I think that as all of this uncertainty continues to reign, There is a lot of care from a lot of customers into managing their inventories very tightly and waiting a bit to see what does all of this mean from a tariff regime, from a consumer confidence, so that they can then get back into optimizing their supply chain and ordering what they are sure they're going to be able to sell. So actually, if you look at it from how the third quarter is shaping up, the third quarter looks very much like a continuation of the second. Very resilient demand outside of the United States, subdued demand into the United States because of uncertainty, and a pricing environment that still continues to be fairly favorable.
Yeah, and when I spoke to Hapag-Lloyd a little bit earlier in the year, they actually said that, tariffs are obviously, a part of the dimension here for shippers, but actually the bigger concern and the bigger cost driver is what we're seeing in the Red Sea and the inability for ships to navigate. Can you give us a little bit more sort of precision on your view of that situation there and when you think ships will be passing there once again?
Yeah, I think we have a clear view that going back through the Red Sea and through the Suez Canal is not something that is going to happen during this year. Whereas in May and June, the situation looked like maybe it was slowly normalizing. The fact that a couple of ships have been sunk by the Houthis very recently is certainly pushing or stressing the lack of security that there still is in doing this, and the lack of visibility that there is on how long this security could be provided when it comes back. So we actually do foresee that the cost that there is in having to sail the longer routes around Africa to Europe or to the eastern seaboard, this is going to be with us for at least the rest of the year. And then we'll have to look at some point at how we read the situation into the next year. But right now, a combination of recent attacks on shipping and a continued worsening of the situation in Gaza is not leading to optimism from our side that we're going to be able to return to normal trading routes in the near future.
Vincent, you mentioned that keyword security, and we have this conversation with you every quarter when it comes to those reassurances, at least around the Red Sea. Have you spoken to the U.S. government or arguably even the U.K. government about what those security plans look like?
Yes, we're in constant dialogue actually with the U.S. military and with respect to what's the security situation over there. I think given the amount of traffic that there is and the amount of ships that you would need to protect, the naval presence that there is internationally in the area is insufficient to guarantee security for everything that needs to trade. And even for some of the ships, it doesn't mean that you're not taking a certain amount of risk. We have seen on some of our ships earlier into last year that even under escort, you can still be subject to attacks and you can still have a pretty close call. And that's why we have taken a very careful approach right now, both for the security of our crew, but also the security of our assets and our customers' cargo.
Vincent, a final question to you when it comes to Mexico. You mentioned this earlier in terms of some of the trade negotiations that you are continuing to watch. We know the U.S. and Mexico have continued their dialogue and are pushing that extension for another 90 days or so. Just walk us through that trend if you see one. As you see the United States actively pull away from China and their exposure there, does reshoring, does friendshoring into Canada or Mexico hurt container shipments? How does that affect your bottom line?
Well, I think that if you look at what is subject to reshoring or nearshoring into Mexico, it's very prone on certain verticals, such as especially electronics, automotive, and consumer goods, which are important verticals. But you have so many different levels of suppliers that a lot of it would mean actually increase in container traffic into Mexico for further assembly into Mexico before being processed. So there is a lot of local content rule and so on. That means that even the nearshoring or friendshoring doesn't necessarily mean that you're cutting the umbilical cord with all of your supply chain from other parts of the world. So there will still be a necessity to move volumes. It will take time also to establish the manufacturing base and the type of scale that is needed in Mexico to replace China in the supply chain. So I think in the near term, this will have minimal impact. In the longer term, it may have more impact. And this is where I think the constant care that we have had in diversifying our portfolio, in moving a lot into the logistics and the land transports and some of the more domestic activities will help us balance the downside that there might be in the long run on container shipping by having a big upside on our logistics business. And that's certainly for us, as we look at the long term, something that we're quite optimistic about.
All right, Vincent Clerc, the CEO at Maersk, giving us his world tour for this earnings quarter. We thank you so much for your time this morning. Guys, I think it's really fascinating what he said there. I mean, we talked about the Red Sea kind of security situation as well. We're still waiting for updates when it comes to China and Mexico. I thought was interesting that he had a very clear take on that being kind of the next junction to keep an eye on. But all in all, some of these optimisms, business optimism, consumer optimism, still very much baked into these results.
Yeah, and the comment from the CEO saying that there's been no front-loading seen ahead of the latest round of tariffs. You could argue that's maybe a bad thing. Maybe U.S. companies haven't buffered their inventory, or maybe that's a good thing. U.S. companies aren't worried. They don't need to front-load the tariff. They've already rerouted their supply chain. So a lot to chew over from that comment.
Yeah, and I think it's such a fascinating company to do a little bit of reading into the broader stories. I mean, weakness in China, not at all the story from where Maersk is sitting. They're really seeing resilience and strength there, and I think that's, an interesting perspective. And also the fact that ex-USA, the trade is happening. This is what European policymakers are saying. We need to trade with everybody else, and that is apparently bearing out in the Maersk numbers.
The fact that it's happening this quickly is fascinating. Coming up, we're going to see how all these earnings are digested at the opening trade. 5 minutes away, this is Bloomberg. A few minutes to go until the opening trade. I think the last 24 hours have been fascinating because it is slow, it's August, it's summer, and yet there's so much going on. And you can see it in this chart in terms of what's happened in the indexes on both sides of the Atlantic. Of course, a little bit of doomsday, a little bit of bearishness when it comes to the European session. But take a look at this move over in the States. By the way, just half of this move in the S&P 500 came from one company, and that's Apple. Promises of $100 billion investment carve-outs around chip tariffs. We'll see if some of that bleeds into today's session, Val.
Well, it's looking like the futures are reporting positive, at least when it comes to Euro Stoxx 50, up 0.3%, a slight outperformance when it comes to those S&P 500 futures. Continuing the theme of the week, it does seem to be like European stocks are having a better week than the U.S., regaining that drop on Friday after that weak payroll report. DAX futures also slightly in the green, underperformance in the FTSE 100. Ollie, what kind of stocks and sectors are we having our eye on this morning?
Yeah, again, spoiled once again to choose from all the different earnings stories. I think that really the conversation we just had with the CEO of Maersk is going to be a very interesting one to watch. That'll be the first one on the radar this morning. Called up about 3% today. I have to say, a very bullish outlook in a moment of basically singular global trade war. I'm bullish on the macro outlook in terms of growth, not seeing a diminishing there. Bullish on China, and saying that actually outside of the United States, trade has augmented substantially. Rheinmetall, again, coming in with very high expectations, being called a little bit lower. Maybe missing a little bit of the estimates, but let's not lose sight of the fact that this is a stock that has rallied more than 1,000% since the beginning of the war in Ukraine. And of course, chips always in focus. We're starting to learn what gets you an exemption in the United States. Is that bullish? Is it bearish? We'll find out.
We certainly will. I think it's really crucial to see whether or not this is actually reflected. So much of that chip story, at least in the last 24 hours, has largely been one that's affected U.S. mega cap. Does it affect the likes of ASML, et cetera? We'll find out in just moments. It is, of course, the opening trade. Let's open these markets now. The FTSE 100, right off the bat, we kind of knew from the futures picture it was going to be on the back foot. This morning, you are starting to see that as well. And I wonder how much of this is just light volume, light liquidity. We're going to wait for those numbers to shake out. But a lot of those earnings stories we're talking about this morning are concentrated in Europe, are concentrated specifically in Germany. We had Siemens. We also had Maersk as well, which is not a German company, but of course one of the bellwethers that we are watching. Not to mention Rheinmetall, as Ollie was mentioning, and a sea of others as well. The Stock 600 right there, finally getting into the green. The CAC 40 higher by 0.2%. But we've got to keep one eye on the DAX, one eye on the Swiss market as well, because of course we know the Swiss president has come back to continental Europe with no trade deal on the horizon. Val, walk us through what we're seeing underneath the hood.
It's a bit split when it does come to the sectors. We do have some of the more cyclical sectors at the top of the basket, like travel and leisure and banks. We currently have 13 in the green, the remainder, the last 7 in the red. So it does seem to be a bit split. But Ollie, my eye went straight to the Maersk opening price, opening up 5%. It's now up around 4%. This is off the back of raising their guidance. It seems like the shipping industry is still giving a bullish tail, even amid the global trade war.
Yeah, we like a big move with a punctual open, rare enough as it is for us here in Europe. But as you say, coming down just a little bit with Maersk down up about 3%. I'm still waiting to get a price on Rheinmetall, something we're going to watch a lot, very, very closely. You know, maybe call down a little bit just because there's been so much positive sentiment built into this stock. And IHG, again, also waiting for the open there.
Well, we do have some of these tech stocks opened. As mentioned, we're keeping an eye on them. We did see such a positive session in Asia with TSMC up some 5% on these exemptions. We're seeing some positivity feed in through the European session as well, seeing the likes of ASM and ASML up around 1.5%. So it does seem to be like this exemption. Yes, it was a big 100% tariff number on chips, but that lengthy exemption list is leading some of these stocks to rally afterwards.
I know, it's a fascinating one as well. The ASML story, it feels like we can't really tell if they are actually benefiting from this or not, because ultimately the fundamental thesis is that you're building out your manufacturing capability stateside. Ultimately, you need to invest in the infrastructure to actually do that. And I guess that is a big help for ASML. But note that AI theme really shows up in the likes of Schneider Electric as well. That's a Guy Johnson favorite over in the Core 6. But so is Relix. That's an Anna Edwards favorite, by the way, which is really kind of a legal doctrine company, but has been really benefiting from the AI trade. So I think that's likely showing up in these numbers.
Yeah, and seeing also some weakness in Siemens. They had earnings out a little bit earlier today, kind of a mixed bag for them. We saw a huge order for trains, you know, so the old school heavy industry still doing some heavy lifting for Siemens, but then their digital industries, this is their sort of automation business for factories across the world, not really picking up the slack, and you can see that in the stock this morning, down by 1.5 percentage points.
Yeah, we stay with the pharma sector there. We are seeing the shares of Merck, Germany's Merck, in the red, down some 2.5%. We did speak to the company earlier. Was a miss on some of their numbers, so it seems like that's the reason why the stock is trading lower today. Let's bring in our guest here sitting around the table this morning to discuss some of these market moves. Fabiano Fedeli, M&G Investment Manager, CIO for Equities, Multi-Asset, and Sustainability. Thank you for joining us on this snoozy week in August for some markets, but here in Europe, we're busy with earnings season. Any big takeaways for how these European companies are dealing with not only tariffs, but the FX headwinds?
Good morning, Valerie. Yes, the main takeaway is until now we really haven't seen the impact of tariffs on markets besides some uncertainty among the companies. And our concern is that going forward, we are starting to see some of that impact. And so we'll have to see how the next 6 months pan out. But one of the key takeaways from the earnings season is that companies continue to be very different in the way they perform. So you've seen companies in the same sector, you mentioned healthcare, for example, that are having very different results. And that is also actually showing up in price dispersion. You're seeing higher price dispersion in healthcare, in consumer discretionary, and in technology. And I believe that we will continue to see this.
I'm always trying to build a bearish picture because I guess that's my nature. But again, at the same time, we see all this euphoria across so many of the markets. We see sort of, you know, the equities particularly doing very, very well, while at the same time these extremely high levels of uncertainty, foundational questions about some of the market architecture that we have. When do we start building a bearish picture? What does that look like?
So what we've seen so far has been a sense of crisis fatigue among investors. They've had so many times that the news flow was negative. We had 2 wars, we had COVID, we had the tariff war, and we have all learned that actually unless this impacts the global macroeconomy or company fundamentals, then it doesn't really affect the investment outlook. However, we're starting to see some numbers, and it's very initial at this point, and it's mostly macro, starting to weaken. I mean, we're seeing in the U.S., we've seen the ISM business pricing having the highest pressures in 2022. We've seen, obviously, the payrolls last week. We're seeing some signs that consumption is weakening. So while it's too early to tell, I think we are possibly starting to get more cautious, or we need to get more cautious on markets. Never say never, because we've been, or the markets have been cautious many times. How many times have we been told to invest in fixed income because equities would underperform over the last
familiar, right?
2
Yes,
years?
it does.
And equities
and then you missed the tech trade.
have performed very well. But also there is a matter of dispersion in fundamentals. Some companies continue to do very well. For example, on technology, the AI-driven technology trade, and some others are having difficulties.
Fabiana, you mentioned some concerns are brewing. You mentioned the payroll miss, the weak ISM services number, and manufacturing that we've had in the recent days. Is there something else that would really start to spark concerns that this bearish view of yours should be moved up in its timeline?
I think simply more data in that direction, and also more companies that are showing impact from tariffs. I mean, the tariff war doesn't help anyone, right? But we're starting to see winners and losers. So not everyone will be negatively affected. You're seeing some results, for example, Toyota overnight, which is affected by tariffs, but you're also seeing companies that actually are faring very well. So more data points on that will actually give us some clarity.
Yeah, I just want to take a moment to acknowledge some of the movers we've seen this morning now. Intercontinental now open, up almost 9% off of the earnings, raising some of its outlook going forward. On the other side of that trade, also Rheinmetall, we mentioned it at the open, we didn't have a price, down 6% this morning. Again, we have to say a huge amount of positive momentum has been built into the stock, up some 250% over the last year. But this morning, some investors taking some profits out that, down about 6%.
Fabiana, let's dive into that. Rheinmetall is taking a beating, not just today, it has been lately. Is the defense trade over in Europe? If we're talking about valuations, if we're talking about returning and reversing some of the trade we've seen in the last quarter and last 6 months, how are you thinking about defense and allocating to European defense right now?
Kriti, if you remember, we talked about this last time that I was here, and our stance was clearly defense has momentum behind it, but you have to justify those valuations. And it's not surprising to see a moment of pause in that run. Longer term, some of these stocks will continue to see some very good fundamental results as long as that defense spending actually comes out as expected. But, you know, when there is so much momentum, so much expectation built in a stock, you are bound to have some disappointments in the short term.
Well, it sounds like, if I didn't know any better, it sounds like you're describing the tech story, and you're not, which I think says a lot about this idea of the sustainability, perhaps, of that European reallocation trade. Is it over?
We still like Europe. We continue to be, if you want, selective in what we buy. But one of the things that we've started to do, because cyclicals have done so well in Europe, and there is still an economic momentum that is weak in the region, we have started to look more into high-quality stocks, which actually have underperformed. And so we have started to rotate portfolios. Always, hasn't been a big rotation, but we're starting to see some really interesting opportunities where higher quality stocks have underperformed.
Fabiana, it kind of sounds like everything's fine. It kind of sounds like, despite the wars, despite the tariffs, and despite a slowing economy, and perhaps being late cycle, everything is actually fine. When you're looking at some of these earnings numbers, we're talking to every CEO, we're looking at these numbers, and there's resilience. It's not massive growth necessarily, but there is resilience from a business perspective and from a consumer perspective. Is everything fine?
There's not resilience everywhere, and that is the key point. I mean, when you are looking at an index level, not everything is rosy. Valuations are substantial, and the economic momentum is likely to slow down. So there is resilience in certain companies when you have very high innovation, very strong competitive advantage, when you have very good management, but that's not everywhere.
I want to ask a final question on this Fed pick that we're expected to hear from Trump this week to replace Adriana Kugler. He said recently, even yesterday, that it could be just a temporary pick to the Federal Reserve Board of Governors. Is that something you are concerned about and are watching? I mean, I guess the market assumes it's going to be someone dovish, but if we get a wild card pick, could that be something that could jolt these summer markets?
Well, the good thing is that not only one person makes a decision, right? It takes a decision for the Fed. So from that point of view, I think in practice, it doesn't really make a big change. What it does, however, it affects sentiment, and that's a very fine line that the government in the U.S. is threading, because investors need to have confidence in an independent Fed.
All right, Fabiana Fedeli, M&G Investments CIO, walking us through the market trade this morning. We thank you so much for your time. Let's get a quick check on the core six. Of course, the heavyweights that tend to move the European market. Green on the screen, 6 out of 6, an A++ across the board. Novo Nordisk, I think, is the highlight for me, only because it's not moving in line with the rest of some of these heavyweights. Nestle as well, and I think that underperformance in both the pharmaceuticals as well as some of those Swiss stocks is really prevalent, or maybe a little bit of a hangover in terms of what we're seeing on the tariff picture and the trade picture from the United States. But again, the tech theme is in full swing. ASML, Schneider Electric, both catching a bit, perhaps playing a little bit of catch up to the news from Donald Trump's chips announcement, but also the exemptions and the carve-outs that are baked into it. That is a picture of your Core 6. Let's check on some of the other individual stocks on the move. Louise Moon has that for us. Louise.
Good morning. As you say, a big day of earnings this morning, so we'll get into some of the movers that we're seeing. So first up, we've got shipping giant Maersk. They're up almost 6% this morning. That's after they raised that outlook. They're saying there's a lot of demand, particularly outside the US. Moving on to Rheinmetall in Germany. Their shares down more than 7%, so heavily in the red this morning. They've obviously been on an absolute tear over the past year and more. Their shares up heavily, so this is paring some of those gains. That's after they missed estimates this morning. WPP over in the UK down over 4%, almost 5%. They issued a profit warning in July and essentially kept things in line with that this morning, but the picture is still essentially very negative. And then finally, we're looking at Deutsche Telekom. So they raised their outlook. They raised their 2025 outlook. Shares, however, down in the red. There's a bit of weakness in Germany, so that's kind of offsetting the positive news this morning.
Louise Moon from our equities team, thank you so much for those movers. And Ollie, Rheinmetall has been paused on a volatility interruption. So we saw there it's down some 7%, but it seems like the stock has had a torrential 12 first minutes of trade.
Absolutely, yeah, down 7%. I wonder if it's going to go even further from here. I mean, the real question here, as we've talked about, has done so well over the last few months. I think there's so many questions. I'm glad we're going to talk about it a little bit later in the show. We look at the backlogs for some of these defense companies. That's great for a defense company. That's guaranteed orders forever and ever. For a government that's using taxpayer money to buy this stuff, are they going to be patient forever? Like, when do we have a conversation about getting that output up more in a more serious way and actually getting deliveries of some of these arms?
Well, that's the issue, right? That's the issue that Fabiano was talking about when it comes to the valuations of some of these defense companies. Even arguably some of the valuations of these investment promises that are being made in the States. These are, at the end of the day, promises. The execution is what needs to drive the market moving forward.
And you could argue, Trump having that meeting with Putin and Zelenskiy with perhaps a ceasefire on the cards could lead some of these defense valuations to come down quite a bit on the back of that, because then that urgency around that defense spending just softens throughout the year.
And we're back open, just bouncing slightly off the low, down 6% now.
Lots to digest in terms of these earnings stories, but we're not done yet. Coming up, we're going to dive into another one. Shares of IHG surging on the back of that earnings release. We'll speak to the CEO in just a few minutes. Stick with us. This is Bloomberg.
What is really important for us right now is to see where this is landing with China. This is something that has yet to get fleshed out, and once we have this in place, then I think we will see uncertainty ebb, and we will start to see customers actually understanding what they need to do now to adjust their supply chain to what is a structurally different trading environment given the tariff levels and the different deals that have been put in place.
Maersk CEO Vincent Clerc speaking to Bloomberg just a few minutes ago. I want to take a quick check at the share price here because they are thriving when it comes to these numbers, higher by 5.4%. And I think what's interesting about this particular earnings set, and I think the narrative we've heard from this morning across a lot of companies that are commenting on that tariff story, is simply the idea that the fear of business freezes, business investment getting halted, even consumer confidence getting hit is not the narrative we're seeing. In fact, we're seeing resilience across the globe, despite some of these really scary numbers that have been put forth in terms of the tariff impact. It looks like a lot of this has been pulled forward. A lot of this really speaks to the idea of how much cash so many of these corporates and these consumers are able to bring to the table. Let's have this conversation perhaps from another perspective, this time from a company that is very much exposed to the consumer. IHG shares also rallying this morning, higher by 5%. Their net profit beating estimates across the board. Their RevPAR also beating some of their projections. Let's see what's underneath the hood of this success. I'm pleased to say the CEO of IHG Hotels and Resorts, Elie Maalouf, joins the program. Elie, a pleasure to have you. Thank you so much for your time this morning. Walk us through your success story here. What is driving this positivity amid a world, as I just said, that is dealing with so much uncertainty? What is the secret sauce to your success?
Well, look, we're pleased with our team's performance in the first half of the year. As you mentioned, our RevPAR was up 1.8%. Our operating profit up 13%. Earnings per share up 19%. When you look more broadly, there was really very strong demand from our owner investors for our world-class brands. We had a record openings of rooms around the world, over 200 hotels. We also signed another 320 hotels into our pipeline. I'm really proud of our teams who reached the important milestone of 1 million open rooms around the world. I mean, an incredible milestone for IHG and all of our decades around the world. What's really driving it, you've got our main industry body projecting that this year, the travel industry will contribute over $12 trillion to the global economy. And we're very well positioned in our strategy and our model of being globally diversified, geographically diversified, diversified by brand segment, diversified by fee stream. We're very well positioned to capture a good share of that growth.
Well, Elie, talk to us a little bit about your China exposure here, because it feels like when you're looking at some of those RevPAR numbers, it's your Greater China business, that is perhaps starting to fall, starting to have a little bit of weakness. Talk to us about, one, how you plan on addressing that, and two, what you associate that drop to.
And so what we're seeing in China, we've been seeing it for a while. There is an overhang from the overbuilding of the residential market. That's been impacting the market for a couple of years now. And we said at the beginning of the year that China was bottoming out and that our business was bottoming out in China. And we're seeing that. Our second quarter RevPAR was better than our first quarter. Our second quarter RevPAR this year was better than second quarter last year. So we're seeing that bottoming out as the real estate, the overhang gets digested through the economy. Meanwhile, you have a $20 trillion economy with many sectors that are doing well. Electric vehicles doing very well. Technology, artificial intelligence doing very well. You saw their export numbers today up over 7%. You saw their GDP growth in the second quarter up over 5%. So it's not just a one-horse economy. It's a big $20 trillion economy that's still growing at over 5%. And within that, travel is still growing. If you look at our occupancy, it was basically flat, which means that the demand is still growing for our business. Meanwhile, we had record number of hotel openings and signings in China. We're looking at another record for the rest of the year. So, we're pretty constructive, optimistic about the long term in China. You got a middle class that's going to double over the next 10 years. You've got, strong technology investment. You've got an under penetration of hotel rooms, like 1/5 of what it is in the United States. So the long term is pretty optimistic in China.
But sort of gauging the consumer from everything that we're seeing, there's a lot of risks still. How vulnerable are some of your assumptions going forward, just given what we're seeing in the macro outlook, maybe some concerns about slowdown in the United States and across the world? And as a sort of addition to that, where are you confident that, that is more insulated and where you're willing to put sort of CapEx to work around the world?
Well, we're looking at the situation a bit over an arc of time. When you started, say, in March and April, you saw a lot of turbulence, a lot of tension, a lot of volatility around trade, around policy, rates, financial markets responded negatively to that. We think that was the peak. And we said in May that we believed we were past the peak. And here we are in August, and I think that's turned out to be true. Sure, there's still some uncertainty. And you know what? There's always going to be uncertainty in this world. But we think we're past the peak of that uncertainty. You've got more trade deals and trade tensions today. You've got, clarity on the U.S. tax bill. You've got financial markets that have recovered, in fact, at a record, really, in the United States and some parts of Europe at a record. And you've got, stable interest rates and inflation in the United States. Then when you look at the United States in particular, you've got employment still at a record. Yes, the jobs report last week wasn't as people expected, but it was still jobs growth. And so you've got employment at a record. You've got GDP growing at 3% in the U.S., clarity on the tax regime, financial markets at a record investment, capital investment in technology, on data centers, power. I mean, all that's a pretty good foundational base for constructive growth going forward in the United States.
And so those are the capital flows. I'd like to talk about the human flows, about where people are going, where you're seeing demand shift. I remember I spoke to the CEO of Accor in the spring, and he said that people from Europe had cut their sort of summer bookings to the U.S. down 25% in the wake of Trump's election and some of the headlines of what was going on at the border. I'd like to get an idea of whether or not that is something that you have seen or that is sort of dissipated. And also, there's been a lot of stories about people not going to some of the traditional vacation spots in Europe. It's getting too hot. What are you seeing there?
Those were comments made by some people during that peak of turbulence, right? March, April. Yeah. I'd say for the first half of the year, our international inbound in the United States was actually up year over year. A little less from some countries, a little more for some other countries. Interestingly, UK, Germany, China, Japan, those were positive year over year. Some other countries were a little bit down. So I think it's a very diversified world. And over time, there's been more demand of people going into the United States for us in the first half of the year. Fewer from Canada, more from some other countries. But I'll tell you the other thing. We're in all these countries. We're in over 100 countries around the world. So if you choose to travel domestically or go to a different destination, we're there for you too.
Elie, we've heard a lot of a similar theme from European companies talking about how FX has affected their bottom line with the dollar weakening so substantially in the first half. How has your business dealt with the changes in FX?
Really hasn't been a big issue for us on our earnings. We're, again, broadly diversified globally. We're reporting dollars already as it is. Our biggest business is in the United States, but it's a domestic business, right? It's a domestic business. So we're not exposed to trade or to, moving goods across countries. So FX has not been a big factor in the first half of the year for us.
Well, Elie Maalouf, the CEO of IHG Hotels, thank you so much for joining us this morning. The stock coming a little bit down from the highs. We saw it up as much as 8% earlier this morning, now up 5.5%. And that'll be, one of the other big earnings stories that we've been discussing this morning. Some interesting sort of observations about where people are going, and that sort of sell America trade as far as tourism is not holding up.
Yeah, that was just a scare in May and April. But transatlantic travel, transatlantic shipping, as Maersk was commenting, is more than back.
I think what's interesting, though, is that we're not crazy. This did happen. There was a pause in the data. We did see travel stop for a moment. We did see bookings stop for a moment, where everyone kind of stayed within their side of the Atlantic for a quick beat. The fact that it recovered that quickly, I think, is pretty staggering. And I think in maybe a year's time, we'll probably see more of this pattern and see this idea that maybe this kind of stop, this kind of pause, start kind of function is really behavioral change from a lot of companies after their experience with COVID. I think that's pretty interesting.
Yeah, well, this beat in IHG is leading the travel and leisure sector to be the best performing sector so far this morning. It's also lifting the likes of Accor. I know that's a business that you spoke to also, Ollie. So this beat from IHG doing a lot to shift the sector. Yeah, and going around elsewhere, I mean, Rheinmetall bouncing off the lows, Maersk still up about 4%. So that's just some of the earnings that we've got to deal with today. In addition to Allianz, which we haven't spoken about yet, but we'll be very lucky to speak to the CFO after the break, get through some of their numbers. Massive inflows to PIMCO and the bond fund. That'll be next, and this is Bloomberg. This is the opening trade. We are about 30 minutes into the session today. What are we seeing? Broadly speaking, green across the screen with one exception, and that is here in London, the United Kingdom, down by 1/3 of 1 percentage point. Otherwise, though, Eurostoxx 600, I should say, trading reasonably flat. DAX as well, reasonably flat. The CAC getting a little bit of that action, but I think under the hood today, as of the earnings season, is where a lot of the action is going on. We know, for example, Rheinmetall dragging down Germany, and a number of other ones beneath the surface, Kriti.
It's cloudy in London. That makes it a little bit of a weight on the FTSE 100. That tracks, I think. Let's talk a little bit about what we're seeing in the volume picture, because traditionally when you see volume this light, you do see markets a little bit on the autopilot to the upside. Today may be a little bit of a breather from that trend. Volume versus the 100-day average down about 28%. And it's showing up in a little bit of a mixed bag when it comes to what the Stock 600 is doing. I want to go to the 52-week highs, though, because I think this trend is really interesting. Banking stocks across the board are getting a bit. BBVA, Banco Sabadell, the theme there. Spanish banks really in focus. And a lot of those, of course, might be just simply a takeover story there. But Standard Chartered also getting a little bit of a boost, higher by about 1%. The anomaly amid some of that doomsday in the FTSE 100. But speaking of doomsday, let's talk about those 52-week lows, because that's where you are certainly seeing some pain. Of course, Merck is really taking a hit, down about 3.6%. They had some misses in their earning. Adidas as well, down about 0.6%. I will not call it Adidas. It's Adidas to me. And WTP, I think, is also interesting. We haven't hit this yet. This is an earnings story, a dividend cut, and a results miss weighing on those shares, Val.
Well, here's what else you need to know on this Thursday morning. President Donald Trump's sweeping new tariffs are officially in effect. Taken together, they will push the average U.S. rate to 15.2%, according to Bloomberg economists. But Trump is still surprising markets, announcing a 100% tariff on chip imports while exempting companies that move production back to the U.S. And over to Germany, where German industrial production has suffered its biggest drop in almost a year, driven by weakness in machinery and equipment. Pharmaceuticals and food also added to the softness. The print is the latest setback for Europe's largest economy as it reels from trade conditions with the U.S. And lastly, Rheinmetall shares are on a back foot this morning after the company posted worse than expected sales numbers. The results signal orders from increased European defense spending have yet to materialize. Kriti?
Lots to digest there in terms of the earnings picture. Rheinmetall is certainly taking a little bit of a beating this morning, down a whopping 5%, as Valerie said. I think this is so crucial when we're talking about this earnings story. It feels like a lot of the heat right now, Elie, seems to be actually in Germany, where we are seeing a consistent set of earnings misses across the board. SAP seems to be doing the heavy lifting in that index.
Yeah, I mean, as you mentioned, also Rheinmetall, we're seeing it there on the screen, down almost 5%. Off of some of the lows, it was frozen a little earlier due to some volatility when it was lost about 7% of its value. So significant downturn. But again, we put that perennial footnote there. This is a stock that has rallied unbelievably over the last few years, thousands of percent, since the beginning of the first war. And then another one we're actually watching this morning is Allianz, which is actually now up about almost 4 percentage points. The shares are higher in the insurance group after they posted a strong second quarter showing, with operating profit coming in ahead of expectations and massive inflows into the bond fund over at PIMCO. And we're very pleased to be joined by the Chief Financial Officer, Claire-Marie Coste-Lepoutre. Thank you so much for joining us this morning. I'd like to start there in what you saw in terms of the flows over at the bond fund and PIMCO and what you've seen actually so far in the third quarter.
Yeah, thank you very much and good morning to all of you. So indeed, the Allianz Group has posted an excellent set of results this morning, and the second quarter is also building on an excellent first half overall. We have seen a growth, 8% coming from our three segments, which is very important, including asset management, including PIMCO. I'm coming back to that in a minute. And we are delivering a record level of operating profit, which we are building on a record level of operating profit already in the fourth quarter and the first quarter of this year. So this is definitely demonstrating the consistency of the delivery of our performance. Again, today we are creating value for our shareholder with a core ROE which is above 19%, which is an excellent result. And I will say even more importantly, in the current environment we are into, our resilience is very strong, and we have a solvency ratio of 209%, which makes us very comfortable when it comes to our outlook for the full year of 16 billion plus minus 1 billion. And indeed, you were mentioning that PIMCO has an excellent set of inflows. So basically, for the first half of the year, we have seen almost 42 billion of inflows at PIMCO. The month of July is excellent as well. And what we see very clearly, I think the fixed income market is very interesting, right? Because opposite to the equity market that is much more moving to passive, in the fixed income world, investors value technical excellence. They value excellence coming from the investors, from the asset managers that can pick and select what are the best investments in the turbulent environment. And we have a lot of turbulence right now, so it's definitely a very good opportunity. And that's what we see as well, supported by the very strong performance and alpha captured of PIMCO.
And indeed, you have to sort of navigate the turbulence you talk about within the markets, but there's also a lot of geopolitical turbulence, and there's also a lot potentially of opportunities for Allianz itself in a world in which we're talking increasingly about bigger and bigger European champions, particularly in asset management. In order to compete substantially with the United States, that will require more scale. What role does Allianz want to play, and are you willing to go sort of aggressively into M&A? How are you thinking about that, and what the role of Allianz will be as a European champion?
So I think Allianz already today is very international. It's global. It's not European only. Look at PIMCO, that is like in the US. So we are really global, a global player. Our strategy in terms of M&A is bolt-on. So we want to add scale where it makes sense. As an example, in the P&C business where we are not in the top three, we want to achieve this top three position in our markets because this allows us to deploy our platform and to create value out of our platform, right? We are also focusing on distribution as an example, in particular also adding certain type of distribution access also for our asset management business. And when it comes to our asset management business, we are usually more looking at teams, picking up on teams to add to the setup. So we are very happy with the way we are now playing with our M&A games, and this is definitely creating a lot of value for the group overall, the way we are doing it today.
Claire Marie, it's Valerie here. Can I ask you a follow-up question on that M&A? We know that you paused some talks with Amundi over some potential tie-up. Is that something you're looking to restart?
So, I mean, if you look at our setup today, right, so we have our three segments. So we have P&C, Life and Health, Asset Management. Those three are very important. They are really the cylinders that are creating the diversification, the resilience of the organization. So that's very important for us. And we are definitely not in the camp that asset management is not needed in our setup. We like having asset management. We believe it's creating a lot of value as well for our customers, in particular when it comes to the life and the asset management convergence. So, and then if you look at our setup within the asset management business, today PIMCO and AGI are very complementary, both from a geographical perspective and from a technical perspective, if you want, given the underlying offering. So I will say we are very happy with our setup today. We are not looking at changing it the way it is today, but we are also always open to any type of conversation. So we are constantly discussing, and if good ideas would emerge in that context I was mentioning, we would always engage with any parties.
Claire Marie, can you expand a bit on the second quarter profit that you did see rise in your insurance business? Is that something you see as sustainable, a sustainable track for the insurance business through the end of the year?
So I mean, we are planning, right, with on the insurance business side, on the P&C side, with 6 to 7% total business growth. That's what we are basically looking at. We see different type of trends, right, because we have a very big portfolio. So across geographies and across line of business, it's a bit different. So to give a general answer is always a bit difficult. But maybe I can give you some highlights on what we have seen. So in particular, in the first half of the year, I think we have seen very strong proof point of the strategy we were presenting in the Capital Market Day when it comes to our platform play, which is really like building platforms on which we can access, we can build B2B business, which is really growing nicely. That's what we have seen with the growth of Allianz partners in the first half of the year. Also like a different type of platform play, but very important for the future, right, in building the right type of cost. In motor insurance, as an example, is our direct play, and Allianz Direct, as an example, in the first half of the year, had a total growth of 14%, which is quite impressive, I will say. So we are very confident, and we are building different type of engines to allow high quality growth, tapping into our technical excellence to continue to create value, which is ultimately the most important piece of all.
Claire Marie, it's Kriti in London. Talk to us a little bit about the euro component here. When we look at fund flows, especially when it comes to American or international investors into European money managers, there's always that question of currency exposure. And lately, we have seen a little bit of some of that momentum come out of the euro. We're looking at about a 115 handle at the moment. Talk to us about how that shows up, or maybe doesn't show up, in your bottom line.
So it does show up in our bottom line. Just to give you a sense, in our operating profit for the first half of the year, it represents 160 million against 8.6 billion. So that gives you an order of magnitude. In the second half of the year, we will likely see a bit more of a translation effect from the weaker FX dollar against the euro. So it has some impact into our numbers. When we do our planning, we always take into consideration such type of economic scenario. So that's coming within our range. So that's why we are very confident in general. There is another dimension which I think is even more fundamental and is very important, is the fact that we hedge our dividend over a sort of 10-year logic, but with a 1 year, 100% type of logic, meaning we are securing the cash in order to pay the dividend to our shareholder, which is obviously a very important item when it comes to ultimate value creation.
And as an insurer, you're navigating not only the sort of uncertainties within the market, you're also navigating some of the uncertainties within the insurance sector. And part of that is natural disaster. In the first half of the year, we had a report out from Munich Re saying that there were more than $80 billion of insured losses in the first half, which is well above the average. And half of that was from the LA fires, $131 billion if you take in uninsured losses. Looking at the picture there, and as somebody who does this for a living without the sort of politics, what are you seeing in terms of the picture for the risks associated with natural disasters? We know the value of assets is going up, so those numbers are going up, but also are the frequency of these events going up, and how does that play into your thinking on insurance?
So you are right? If you just look outside of the window currently, I mean, we have some luck today because the weather is beautiful in Munich, I think, in the background, but it was terrible the last few days. It was pouring rains like not possible. I think it's extremely dry in the UK, way too dry. So we see a lot of patterns which are not the usual patterns, so which are clear signals of climate change that we have to take absolutely seriously. The way we are handling it is that on the one hand, we do whatever we can at our level, but also fundamentally, we deploy a lot of technical excellence, which is the only way for us to be able to do that. So we leverage the insights we get from the data, we capture the right data, we do the right modeling in order for us to manage extremely well the accumulation, so that we can secure the famous resilience I was referring to and provide the right level of management of the volatility, which is absolutely essential. What we do as well is that we engage with our customers, in particular in part of the world where cat insurance or nat cat insurance is not mandatory, where you need to do a lot of education to explain and support the customers before it happens. And also, obviously, we are on the ground when things happen. And you may remember that last year, our numbers were impacted by severe natural catastrophes, in particular in Germany. And we demonstrated how we act on the ground, which is absolutely essential for what we cover and what we stand for as an organization.
All right, that was the Allianz CFO, Claire Marie Coste-Leput. Thank you for joining us after your beat in your second quarter earnings. Now, coming up, Siemens shares are under pressure, even as the company reported a rise in both orders and revenue. More on our conversation with the CEO next. This is Bloomberg.
Good Thursday morning. We are 47 minutes into the session this morning, and we find Siemens 47 minutes in, down about 1 percentage point after revenue and orders rose on robust demand for rail products, which helped offset a sharp decline in its software business. I spoke with the CEO, Roland Busch, a little earlier today and asked him if there will be a turnaround in the foreseeable future.
So I wouldn't call it a turnaround compared to what was happening in the past, this kind of recycle recovery. I always said I expect the Chinese market to come back gradually, and that's what we see. We see semiconductor business, for example, coming back, the automotive business having a slight increase. So they're coming back. Chinese government works on cleaning out the real estate problems on the one side, investing in high-tech manufacturing in order to drive productivity in a competitive environment. They're investing also in green technologies. So therefore, that's everything what they do now is tailwind for us, because we are the incumbent in automation. We drive digitalization in this country as well, but also a strong foothold on electrification. That helps the market. And according to our expectations, would come back, but gradually.
And if the Trump administration is to be believed, there are literally trillions and trillions of dollars that are coming into the United States in order to build up manufacturing capacity that should favor, theoretically, digital industries. Have you seen any sign of that in terms of any kind of efforts from other companies that you might be involved in? And do you really take that number at face value?
So we see some pickup there also from order intake in the United States for the automation business, but also revenue. It's too early to say. Again, nobody was investing until the tariffs somehow settled. So we see, I mean, you might have learned that Audi is thinking about building a new production site in the United States, the first one. So it will benefit digital industries and automation in particular. Why? If you really relocate manufacturing to the United States in a market which has high labor cost, and if you get labor at all or trained labor, the best thing what you would do is make it as automated and as digital as possible. Base it on a digital twin with digital threads, and there Siemens technology comes in. So we are market leader from that perspective. We can help every of our customers to really run a manufacturing site highly automated. That's what you want to do if you invest in the United States, and Siemens is here to help.
So the chief executive officer of Siemens there, Roland Busch, really interesting company with sort of exposure to a lot of the different themes we talk about. Obviously, tariffs. He said a little earlier in the conversation that he was not really happy with the deal, but he's happy that there is at least a deal, brings some clarity. They're also exposed to the data sector story in terms of their smart energy and how they sort of interplay with the grid. So that's bullish for them as well. In addition to that factory build out, which we're seeing and we're hearing from people who are actually involved in building and automating factories in the United States, you're starting to see evidence of, Kriti.
It's a fascinating one as we talk about just kind of a lot of the issues that German companies in particular are facing when given in the last 6 months. They've been kind of the golden child of Europe. And it feels like when it comes in an already big backdrop of reallocating to this region. Of course, another kind of golden child of Europe is Rheinmetall. They're not having such a great day today. German defense company, of course, recording an operating profit of 475 million euros in the first half of 2025. That was a miss on the average analyst estimate. Of course, comes the backdrop of orders from increased German and broader European defense spending have yet to materialize. So basically the fears everyone had about this company actually coming true. Jerry Doyle, Bloomberg's global defense editor, joins us here. Jerry, just walk us through basically this manifestation of all of our fears. How real is that underperformance?
The underperformance has to come in the context of the fact they still expect their sales to increase by 25 to 30% this year. There's a lot of upside. Where the uncertainty comes in, and I think what disappointed investors, is that they didn't change their guidance based on the fact that there is increased European defense spending now. That NATO countries have agreed to increase their defense spending to up to 5% of GDP. That's a lot of money going into the defense industry, and I think the expectation was that was going to manifest itself more quickly in the results from companies like Rheinmetall.
But the story around future orders, what kind of picture is Rheinmetall painting for us about, orders to come and how quickly they could?
They did make a point of saying that they could adjust their guidance in the second half of the year. And one of the reasons for that is the German parliament, when it comes back from its break this summer, will pass the budget for the country. And that could include funding for as many as 5,000 Boxer armored fighting vehicles, hundreds of Leopard 2 tanks, other war material that is going to be funded by the German budget. And obviously those kind of numbers would have a big impact on the bottom line of a company like Rheinmetall.
I'd like to talk also a little bit about the difference between backlog and delivery, right? This is something that's blowing out within the defense sector. We see Rheinmetall now with another record backlog of 63 billion euros. That's up from 40 billion last year. Is there a point at which there's going to be more pressure from governments who are saying, listen, we're giving you taxpayer money, we expect delivery? And where does that play into the story for Rheinmetall?
I mean, I think that pressure is already there. There's a lot of immediate demand for the products, things such as, again, the armored fighting vehicles, artillery ammunition, that stuff. And there's been pressure building for years to deliver that more quickly. So I think that might play into what we've seen today as well.
All right, thank you for joining us. That was Jerry Doyle, Bloomberg's global defense editor, on the Rheinmetall miss in their earnings today. I also do want to check on the European chip makers after Trump announced a 100% tariff on semiconductors, but it came with some decent carve-outs. We're seeing the likes of ASML, ASM trade pretty positively, but to the downside, ST Micro and Infineon. So it does seem like not every company is winning from these exemptions, with those in the red maybe being an example of those who haven't pledged U.S. production or pledged U.S. investment.
I mean, that's the trick. That's the secret sauce of success in this market, it seems. And Apple was a great example of that yesterday, despite having massive tariff exposure to China, to India, and other places around the world. Let's talk about what else is coming up in the next 24 hours. You can tell what kind of day it is when the BOE rate decision takes a back seat. That, of course, is coming at 12 p.m. 30 minutes later, it is the press conference. Plenty of earnings and a series of data throughout the rest of the day as well, plus that 30-year bond auction. But I think for now, in the next few hours, let's focus on that BOE rate decision. We, of course, have our correspondent on the ground with us. Bloomberg's Lizzie Burden has us covered. Lizzie, walk us through what we can expect in the next few hours.
Well, Kriti, if you get a dovish tilt from the Bank of England today, of course it would weigh on sterling, but it's going to be hard to make a dovish tilt when you've got inflation at a 17-month high, an expectation that they're going to raise the short-term inflation forecast, and this cut today fully priced. Now, if they emphasise the labour market weakness, then you may see more cuts being priced in after today. But look, this stagflationary backdrop is precisely the reason that lots of economists, most economists, are seeing a three-way vote split today. 2 voting for a half-point cut because they're worried about the growth backdrop and the labour market. 2 voting for a hold because they're worried about inflation being sticky, the likes of Hugh Pill and Catherine Mann there, and the rest for this quarter-point cut. Now, the real surprise could come if gradual gets dropped from the guidance, if the forward path for rates is no longer described as gradual, because maybe that would be a signal that they're veering off this quarterly cadence of quarter-point cuts.
All right, Lizzie Burden on the BOE that we can expect in a couple of hours. She, of course, will be live on the ground and give us those updates. We thank you so much. Let's just recap what we've learned in the last, I want to say, 24 hours. We've learned that earnings are resilient everywhere but Germany, it seems, in the defense sector, which is already still doing not too shabby, but just kind of having to meet some high expectations. There's still tariff uncertainty, geopolitical uncertainty when it comes to Russia, but if anything is saving the day, it's tech.
Yeah, and I think it's just sort of so interesting that we have such an aggressively bullish picture. But again, I think there's one point to sit on that Dan Curtis brought up this to our attention is that $100 billion announcement from Apple pledged to the United States on top of 500 additionally to what they've pledged. They have only ever spent $166 billion in the last 30 years on CapEx. I think it's also a sort of broader conversation about kind of an era now of sort of flagrant potentially corporate deceit, and that's something just as being seen as part of the game in the United States now. Is that a healthy thing?
Well, look, we've also heard from many of the CEO, CFO interviews that they're touting these strong relationships to the U.S. So it's possible these companies pledging this kind of investment only to keep in the administration's good books.
Yeah, we'll see how this all gets priced in the market. Right now, everyone's on summer holiday. We'll take good news where we can get it. That does it for the opening trade. The Pulse is up next. This is Bloomberg.